Welcome to the Safe Wheel live stream where I share my real P&L on 3 accounts and teach my proprietary Safe Wheel trade system for free. Also, please type in the chat that you can hear me okay. I want to make sure my audio is working today. And be sure to post any questions that you might have in the comments section to make sure I can get to any questions before the end of the broadcast. Walter says the audio is good. Thank you, Walter. So first, let me get into the earnings edge. Looking at my screen here, you can see that my balance for the earnings edge account is $8,931. That's my net liquidation value. You don't really see this anywhere else. There might be a couple other people showing this now, but it's pretty rare that you'll actually see a P&L and on a weekly basis. All right, what did I do last week? I traded TSM here and down $228. It was interesting. TSM was scheduled for earnings the following week, which would be this week, when I initially put the trade on, and then they kind of changed it. So I just got out of the trade early and took a relatively small loss on that trade. So let's take a look at the spreadsheet here. TSM minus 228. So record since inception 32.18.6. Since I made my update 11, my record's 11, 10, and 3. You can see my average win 973, average loss 472. And in 2022, did 63% when the S&P did minus 19. See, my goal is to outperform the S&P 500. And now if we look in 2023, up 9.2%, S&P up. See, make sure that 438.94 is accurate. Let's do that first. SPY 439.61. 439.61. S&P up about 15% for the year. And the earnings edge is around 9%. But overall, since I started trading the earnings edge live in January of 2022, I'm up 78.6, where the S&P is down 7.4. So it's outperforming, but there are a lot of drawdowns. So the drawdowns are higher with the earnings edge compared to the S&P 500. So, take that, take the drawdowns with it. And this year, obviously, the S&P is outperforming. But overall, even with the drawdowns, probably the earnings edge is outperforming. Okay. Let's get to the Premier Level 5. How's that doing? I'll move this out of the way here. Premier Level 5. Let's go here. So this is where I trade options on the ES, options on futures. Trading options on futures is very similar to just trading options on the SPX or trading options on the E/ES. Very similar. The S is only about half the SPX, and SPY is one contract. So if SPY was 1/ES would be 5 times that, and SPX would be 10 times that. So this is a half of SPX as far as sizing. Okay, so what is the net liquidation? 35,184. Looking at the record since inception, 18 wins, 6 losses, 6 break evens, and I have 4 open trades right now. Again, I started this on April 8th. I didn't start this on January 1st because I actually developed this trade in 2022. So up 12.2% versus minus 6.3, so outperforming the S&P. Plus the drawdowns were significantly lower. Drawdowns for the PL5 about 5%, and with the S&P 500 in this time frame, it was down 24%. So significantly outperforming, not just on a return basis, but on a risk adjusted basis. And then in 2023, up 4.5, and the S&P again up about 15%. Overall, up 17% versus 7.6, but with about one fourth the amount of drawdowns. So that's vastly outperforming on a risk adjusted basis. Okay, so that's the Premier Level 5. Let's get into the safe wheel. Um, let me double check let me move this out of here. Let's see what the safe wheel account has. 6388, $6,338 in it. 6388, so we're down a little bit from last week. You can see how the safe wheel vastly outperformed the S&P 500, did 21%, while it did minus 19 in 2022. In 2023, up 5 versus 15. So you can see that the S&P 500 is outperforming in terms of returns, but in terms of drawdowns, we get about half the drawdowns with this safe wheel compared to the S&P 500. So you got to take that into consideration, the risk adjusted returns. But even when taking the risk adjusted returns into account in 2023, it looks like we're underperforming a little bit. But still, when I started in 2022 trading this live, up 27.7 versus minus 7.4. So vastly outperforming since I actually started trading this live in January 2022. This is a safe wheel. Okay, so with the safe wheel, those are kind of the performance metrics. What about trading it? Well, let's take a look at where we are. You can see that the safe wheel is up significant today, and did not get assigned last week. So I sold a put, did not get assigned. So I come into Monday with just 3 long puts, my put hedge. So my question is, am I going to keep this put hedge? What am I going to do with it? So the first question is the put hedge under 100 days left before it expires? And the answer is no. So that's good. That tells me I'm possibly going to keep it. And then I want to make sure that my strike price of my put is close enough to the actual price of the underlying. Let's see if it is. So I want to be within 70% of that underlying. 28.2 divided by 0.7. 28.2. I'm sorry, times 0.7 is 19.74. So barely made it in there, right? So I don't have to change this put hedge. Now I do need to keep it within 70% of this price, because it needs to be, the closer it is, the more protection I get. And I got to make sure that I'm protecting myself with it. And it is within the guidelines, barely, of protecting the position that I'm going to put on. So now that I have my put hedge in line, the next thing to do is run the wheel strategy, the traditional wheel strategy. And I always do that with the nearest expiration cycle. In other words, the cycle that expires on Friday, today being Monday. So I'm going to use this expiration cycle here, and I'm going to run the traditional wheel. One thing about it, I want to make sure that I sell a put that's out of the money, and that I get at least $28. So I can sell the $27.50 here, and I can get over $28, and that's what I'm going to do. I'm going to take the furthest one out of the money that I can sell and still get over $28. Mid price right now is 34. I'm going to trade one contract because I have between $5,000 and $10,000. Let's see here. One thing I wanted to mention, I'm possibly thinking of switching. Okay, got that filled. Let me talk about this long call. Okay, so right now I'm going to put on a long call to protect this put hedge. And what I'm thinking about doing possibly is trading these long calls on Fridays rather than coming in on Monday and selling on Friday. Maybe on Friday I'll roll them. In other words, I'll trade it on Friday. Somebody come up with that idea earlier. I think I've heard it a few times. And see, if I had that long call already on, I would have some pretty good protection right now if I'd put it on Friday. Okay, so I'm going to look for something a long call here in the same expiration cycle, and I don't want to pay $7. I'll pay $6. So I probably can't get this one, but I'll pay $4 here, it looks like. And I'm just going to buy one. And I'm trading DraftKings, of course. Okay, so there I have my position on. And like I said, I'm thinking of just tweaking this a little bit and trading these long calls on Fridays. So I'd get out of them and back in on Fridays. And a lot of people follow me on Twitter to see what happens with those long calls. So that's what I would do. I'm not going to come in here and do it live. I'm just going to, people follow me on Twitter. You can see what happened with it. Okay. Also, be sure to help out the channel and help other people find this and hit that like button. Just go ahead and move your mouse over there and just hit that like button real quick. That would help out quite a bit. All right, let's get into questions. See if there's any questions here. All right. Audio's good, thank you. Somehow sounds good. Some guy, how you doing? ATTK, that means I have audio, I believe. Kevin, good morning from Lakeland, Florida. Okay. Lesson more. Wheel question. Let's see here. Less is more. When the wheel was back tested, did you consider buying only 2 put hedges rather than 3? Yes, I did. If so, was there much difference in the returns with 2 rather than 3? Well, the problem I would run into is if the market crashes or goes down significantly, the 2 put hedges would not ever outpace my long 200 shares and the losses that I was taking on those 200 shares. Because if I was long 200 shares right now, maybe I get long 200 shares at 27.50, and maybe I put on a second tier and I get long at let's say 25. So now I've got 2 long shares at 27.50 and 25, but I've got to go all the way down to 20 before the put hedge starts paying off. So that gap between 27.50 and 25 doesn't get made up for unless I've got more 3 compared to 2, unless I've got more hedges than I do long shares. Walter, do you use Sharpe ratio to measure risk-adjusted return, or you have another metric? I do look at the Sharpe ratio, not with these systems. I do with the Synthetic Dragon with a Premier Level 5. I'll look at that, but I also like the Sortino much better because it only measures. So the problem with the Sharpe ratio is if you have a really large upside, like you make a lot of money, it'll be an actual negative on the Sharpe ratio. So I like to take the upside out and just do the Sortino, because really all I care about is my downside risk. But I really don't like the Sharpe or the Sortino because I don't like using the average. It's the averages. I don't like using that when I'm doing risk adjusted. I like the MAR, where you take the total return, the average return that you get every year, and then you take the largest drawdown within that time period. That to me is realistic, rather than taking some average or standard deviation and doing it that way. That's just a way I think of making it look better. But I definitely would pick the Sortino over the Sharpe. Charles, when you buy the put hedge before owning the underlying, what are you actually hedging? Well, I am not. So if the stock goes down, I will end up owning the underlying. So I'm kind of planning ahead. So that's where the hedge is there. It's for when I do own the underlying. Not that I haven't owned the underlying for a while, DK and G, but eventually there's a possibility that I will own it. And when I do, my put hedge will be there for me. ATTK, general question. Why have you favored delta neutral strategies in general? Because I don't believe anyone can predict the future. And I don't believe that you can predict what a stock is going to do in advance. Now, there are trends and you can kind of pick up on those, but then you have the second problem of managing money around that move. So, are you going to size up when you feel like you have a better chance? So, when you add in the money management dynamic of being directional, that's when it really breaks. And so, because of the fact that I don't believe, and I haven't seen anyone be successful, now maybe there is somebody, I just haven't seen them successful picking a direction on a short term basis and managing money around that and being consistently profitable, then I go with delta neutral strategies because of that. So the market seems to go up over a long period of time frame, and you can see committed delta. Yeah. So correct, like over the long term, you're probably going to be good going long. Um, but then again, Japan, 1989. How long did it take for them? Have they even recovered since 1989 yet? So that kind of scenario, or the lost decade, 2000 to 2010. I mean, you literally went 10 years without being up. Those kind of things. Why sit in a lost decade when I can make money during that time frame? So that's why I'm more confident in trading options the way that I trade them than just going long. And you can actually go long with your portfolio and use that same buying power that you used to go long with to trade options so you can double dip. So if you'd like to go long, you can still do that and still do the options trading strategies, a lot of them. I can't remember, but you looked into the idea of buying on Friday and you later reconsidered because you thought of a problem with it. I just can't remember what it was. Exactly. That's why I brought it up today because I thought you guys would bring it back up because I can't remember what the problem was either. I thought there was. Maybe you guys will come up with it. I uh, I thought of it before, but now I'm trying to, I don't remember. Will, my brother wants to look into buying Mattel stock because of the Barbie movie possibly being a hit. You convinced me that telling the future is not easy. Continue. Any option strategy you recommend? I was thinking of making a vol play on the movies released this Friday. What do you think? I don't know how much, I haven't really, that's kind of a fundamental thing. I don't know how much a release of a movie has an effect on a toy company. Like, how has that happened? What's happened to that in the past? If you could maybe get some type of past look into, maybe it's a binary event and you want to play it like that. I am not sure. I haven't looked into that kind of thing. But if it is a binary event, you're going to get that vol crush, right? So if you go long options, you might sell options into the event because you're probably going to get that vol crush. Walter, your reasoning, Sharpie, Sortino, Max Drawdown makes sense. Thanks for the explanation. You're welcome, Walter. Thanks for asking. Will, I was thinking an earnings type play, except the movie release as a catalyst or just a synthetic long stock option strategy. Well, I mean, if you want to go long, just uh, you're probably going to see some depreciation, right? As the event occurs, and then as the event goes by, you're going to see that vol crush. But if you do maybe a call debit spread, you won't see as much of a crush because you're selling something against your long. That's an idea. Those are very general kind of trades. They're not really sophisticated, and because they're not really sophisticated, they're really directional. And if you want to get directional, there's a lot of ways to do it. And that's one way to do it. The Nikkei has not recovered since 1989. Okay, good to know. I wasn't sure. They were talking about it a couple weeks ago. I knew it was coming up, coming higher, but I wasn't sure if it had recovered yet. Will, some articles have predicted the movie would just have a short-term impact on the stock, but not long-term as the company's losing revenue. And so you're talking about a fundamental analysis, you're talking about a story, and you're talking about something that everybody else knows also. So if everybody knows, then how is there an edge, really, right? Unless you can sell some vol, there's really only that edge that I can think of. Some guy says, "Hey, Will, the way movies release have been bombing, so you can go short." Well, maybe you can go short the vol, right, on the event. Okay. Let me check my notes here. I don't see any more questions or comments for today. So, I like to say, as I end the broadcast, if the P&L is not real, what else are they trying to conceal? I'll see you guys again next week. See you then.